One of the best ways to have a successful retirement is to pay as little taxes as possible. A great way of doing that is by income splitting. Hi, my name is Koby and I'm an investment advisor. If you're new to my channel, I focus on helping Canadians smartly invest their money and safely build wealth while paying fewer taxes. In today's video, I will share some of the best income splitting strategies available for Canadians. If wealth creation is something you're interested in, make sure to like and subscribe. It costs you nothing and you'll be notified when I upload a new video. So let's jump right in. Canada uses a progressive tax system that aims to reduce the degree of relative inequality within a country. Unfortunately, it can result in inefficiencies for couples who have significant variance in the income earned by each spouse. Income splitting is the strategy of moving income from one family member in a higher tax bracket to another family member in a lower tax bracket. Income splitting can have a huge impact on the overall tax amount you pay as a family, and since Canada has graduated income tax system, the idea is to reduce the overall family tax burden. To better understand the concept, let's use an example of a couple living in Ontario in 2021, and the first spouse's income is $80,000 and the second one is $0. They might be retired or simply not working. On an $80,000 salary, you would pay about $20,000 in taxes, leaving you with roughly $60,000 net. If you could split the income with your spouse 50-50, it means each of you would earn $40,000. On a $40,000 income, the tax payable is just under $8,000, leaving you with about $32,000. Combining the incomes together, you're looking at a net income of about $65,000 and about $15,500 in taxes. This means you will save almost $5,000 a year. This money can then be spent or invested and compounded. Income splitting is especially important during retirement because on top of the savings, you can also potentially avoid or reduce old age security clawbacks. Let's give another example. This time, let's assume one spouse is earning $155,000 and the other one is again earning $0. In this scenario, the spouse with the high income will have 100% of their OAS payments clawed back. However, if they use income splitting and share their income 50-50, it means each one will be making $77,500 and no OAS payments will be clawed back. Now, keep in mind that income splitting has limitations and attribution rules were added to the Income Tax Act to prevent exploiting this system. For example, if you gift your spouse part of your income, CRA can still attribute any income earned back to you and you'll be taxed at your higher rate. So what methods are allowed and how can you still use income splitting? The first and most common is to split pension income. If you're 65 years or older, you can split up to 50% of eligible pension income with your spouse or common law partner. To do so, both spouses need to fill up Form T1032, which is a joint election to split pension income when you're filing your personal tax returns. The more common pension income which is eligible for income splitting includes lifetime annuity payments under a registered pension plan, deferred profit sharing plan, and payments from a registered income fund, RIF. If you still have an RRSP and want to withdraw money from it, I would recommend converting it to a RIF account first to reduce the amount withheld by your financial institution. If you're planning to retire earlier than 65, you will only be able to split pension income coming from a defined benefit pension plan. The earliest you can do so is when you turn 60. Keep in mind that old age security benefits and Canada pension plan benefits are considered pension income that is not eligible. You can, however, choose to share your CPP payments with your spouse or common law partner, limited to the portion that can be shared. This will be calculated based on the number of months you and your spouse or common law partner live together during the joint contributory period. To do so, you must be receiving your pension or be eligible to receive it. and be physically living with your legal spouse or common law partner. The second way to do income splitting is by contributing to a spousal RRSP. Spousal RRSPs are not so common anymore since income splitting is allowed anyway from registered retirement savings plans in the year you turn 65. However, this would make sense if you are planning to retire at the age of 60, and especially in cases where there is a big difference in income between the two spouses. If this is the case, you would want to contribute to a spousal RRSP to avoid one spouse having a significantly larger RRSP account, which would result in a higher overall tax bill for the family. Next, you would want to have both spouses max out their tax-free savings accounts, or at least have them similar in size. Attribution rules don't matter in this case, as you're contributing with funds that have already been taxed. The funds in your spouse's TFSA can be invested on a tax-free basis. And since you can take out the money at any time, it has a lot more flexibility than an RRSP. Compounded investments will make the money grow over time, so they can have a significant impact on building your family wealth. Another way of income splitting is by utilizing a spousal loan. The idea behind it is to have the higher income earner to lend money to the low income earner spouse to invest, and the income would then be taxed at the hands of the lower income spouse, so the overall family tax bill will be lower. The higher income spouse would need to charge the lower income spouse interest on the loan at the prescribed rate to avoid the CRA attribution rules. Make sure you check with your accountant before utilizing this strategy. The next strategy for income splitting is geared towards business owners. If you own a corporation, you can pay a salary to a family member for work they performed. That paid salary would be a tax deduction for your business and would lower your overall tax bill. This is a great strategy, especially if your children are students and earning low or no income. In 2022, the Ontario basic personal amount is set to $11,141, meaning you can pay your children up to this amount yearly and your children would owe $0 in taxes. The basic personal amount is a non-refundable tax credit that can be claimed by all individuals. The purpose of the BPA is to provide a full reduction from income tax to all individuals with taxable income below the BPA. It also provides a partial reduction to taxpayers with taxable income above the BPA. A non-refundable tax credit reduces what you may owe. However, if your total non-refundable tax credits are more than what you owe, you will not get a refund for the difference. Paying your children, which are normally in a lower tax bracket, would help you reduce your business tax bill and shift money to your children more efficiently. Your children can then contribute and invest their money through their TFSA, assuming they have enough room, and start growing it tax-free. Just a reminder, you should always consult your accountant and get their opinion and approval. Most people would look into income splitting only when they retire or are very close to it. It is always a good idea to start planning or at least educate yourself way in advance so you can start working towards positioning yourself to be in the best place possible when you actually retire. That's it for today's video. I hope you found it valuable. If you haven't done that already, make sure to hit the like button. And if you want to see more videos just like this one, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I will see you on my next video.